Hello, this is Usama Rizvi and welcome to another episode of the Monday Macro View. The second largest economy in the world, China, continues to disappoint the markets. Many people banked upon its reopening post-COVID-19, but so far the figures are not very promising. And now a threat of a deflationary cycle that might be setting in the country is haunting the markets. If it is true, what will that mean for the global economy? We're going to find out in this episode. So, if you look at the first slide, this talks about deflation. Now, there's a difference between deflation and disinflation. Deflation means when these figures like inflation or PPI or different CPI, different measures, they enter the negative territory. But disinflation means, which is in fact a good thing. Disinflation means if, let's assume inflation was 5%, now it is at 3.3%, 3.2%, and 3%. I've written more about it in this week's research article, and you can check it out at primaryvision.co. So, but in China, what happened is that, as you can see, CPI slightly turned negative year-on-year basis at 0.3, whereas the PPI touched minus 4.4. Now, that is very interesting because all across the world in the major global economies, we have crippling inflation, but in China we have the exact opposite. This can mean a lot of things. I'm also looking at it from a positive angle. I'll tell you why as we move down the slides. But this is also concerning in terms of the domestic demand and external demand as well. If you look at PPI, this is the 10th consecutive decline, and the forecast was about 4%. It fell about almost the same, and China's. But there is a catch in it. If you include the main reason for this decline was a decline in pork prices, 26%, and also a little bit combination of weak consumption because of ample supplies. If you look at the core inflation, which excludes food and fuel prices, it still picked up to 0.8% on a year from 0.4% in June. So if you dig deeper into the figures, you see that at this stage, I'm not saying that you can discount it, but at this stage, the threat of a deflationary cycle setting in second largest economy in the world might be exaggerated. But that doesn't mean that Chinese economy is doing great. I myself, Mark, we have done umpteen shows on it and written a lot about it as well, that how Chinese economic data continues to disappoint the markets. As you can see here, China's GDP continued to grow, but it's at a slower pace. It is in the slow lane to recovery. Why is that so? So many analysts, after Beijing abandoned its zero COVID policy, they expected that the economy would roar back and there would be consumption. And if Chinese economy would roar back, of course, that would mean higher imports, which will result into higher revenues for other companies and an uptick in the global economic activity. But it did happen. So Chinese, as you can see, the savings that the Chinese accumulated during COVID-19, they're still there. They didn't spend those. So this household savings surged by about 1.9 trillion euros in 2020, pounds, in 2020, and they almost remain at that point. Chinese are consuming cautiously these days. For instance, the domestic trips during the May Day holiday increased nearly by 20% compared with 2019, but the revenue from those trips only increased less than 1%. So another indicator that shows the lower consumption, domestic consumption, is sales of building materials, which is associated with the very big, very significant property sector. It declined by 7%. So there are underlying issues in the economy. If China's economy stalls, this was a very interesting article in New York Times. There can be many ramifications for the world. China is almost the biggest consumer of all the commodities in the world. But at the same time, we need to understand that Chinese, as we will study, as we will have a look in the next slide, Chinese trade figures show something as well, a decline in import and export. But that also means that things aren't going well in the external economy. So Chinese imports, despite sharp decline in terms of value, the quantity increased in July. So although, according to different analysts, although there is a domestic demand is, insufficient, but it is still better than the external demand. If Chinese economy stalls, it would lead to, because China is responsible, as you can see, and third point, is responsible for more than 40% of the global economic growth over the past decade, compared with only 22% in the US and 9% from the 20 countries that use the euro loan currency. That in of itself makes a huge sort of a portion where a slowdown in Chinese economy can affect all other economies. This is also evident by the steepest fall in the last 3 years in Chinese exports. The imports fell as well. A fall in imports, of course, means lower consumption across the world. A fall in exports means something is wrong with the country as well. But what I'm trying to highlight is that it's not only China. It actually ties in very neatly with all the previous MMVs, the Monday Macro View shows we have done, that the global economy, the real global economy, the real economic indicators, they continue to highlight that there is a slowdown happening. Exports declined by 14.5%, the steepest fall since the outset of coronavirus. Imports tumbled 1.4%. And these are just very important figures. And one of the very important things within these things is that China's US exports, you can see that they have tumbled as well. So that speaks to the threat of the resurgence of a trade war, which is very, very important. If you look at the next slide, it shows car export growth that also failed to offset declines in electronics, apparel, and metal. Actually, manufacturing activity has shrunk across Asia. Even South Korea registered a decline in imports. Even Taiwan registered a decline in exports. So it's regional as well. Finally, if you look at the market sentiment tracker, the market outlooks remains in such a way where sentiments are overtaking the fundamentals. These are all fundamentals. These are all the indicators. This is the second largest economy that we're talking about. There are tight financial conditions right now. US's economy is under most pressure since 2008. Eurozone activity is still down. Eurozone there was a fall in services sector. Chinese exports most down. Germany's industrial economy is down 1.45%. The construction sector is down 2.8%. It can slip again into recession, but we still aren't seeing its effect on the global asset prices. I think it'll happen soon, but so far, the sentiment seems to be overweighing the fundamentals. That's all from today. See you all next week. Thank you.